affiliate accounting. I came in right around the time when we started what we labeled back then the PLLCs. So those were when we had Hudson Valley Newborn, we had the intensivist broken out, hospitalist broken out, we had physician network, basically all different little affiliate physicians, with their own little entity before we merged them in 2009. So I do have, this physician level of background from an accounting perspective. I was 6 months into my position, and there was some changeover at Northern, and we had just brought them on, so they asked me also to take on Northern Dutchess Hospital. So for about the first 5 years here at HealthQuest, I did the physician accounting, and I also did Northern Dutchess Hospital. As the time went on, I grew to take on more of a system role. I had acquired Vassar, and I was just specific to doing Vassar's financials. And then I was named controller, I believe in around 2009 or 10, where I actually was responsible for the entire system's financials, which includes auditing and tax reporting. And then in 2012, I became AVP of Financial Operations, and that kind of encompassed everything but the patient accounting side. When we had some changeover with new management, I did act as interim CFO for a year until we found a replacement, Gary Zmerhal, who is with us today and has been with us now. We're going on his 3rd year. So I went back to my original VP of position, and here I am today. So Dr. Doyle had asked me, I was at a VVMC new board orientation, and I just did a quick little 10-minute education for them on how revenue is recognized. So he had, at the end of the meeting, he said, would you mind doing like a Finance 101 for the medical staff? At our next meeting. So I said, oh, sure, that's not a problem, only to find out that I'm the only one presenting. So hopefully this is enough of the slides, and that it will take up enough of the time. This is really basic accounting 101. This is not getting into, capitation and, all these different types of nuances. This is just really high level, and just to kind of give you various different options from an accounting perspective. So to go into it, basically you have your financial statements. And what are the components of your financial statements? You have your balance sheet, which shows your assets and your liabilities and your net assets. You have your statement of operations, which is also called your profit and loss, or some of us, as we love to live in the world of acronyms, we call it a P&L. For a statement of cash flows, and then a statement of changes in net assets. So basically, if you were to look at somebody's audited financials, these would be, after the auditor's opinion, the first 5 pages of the financials, because this really tells the story of how well the company is doing. From a balance sheet perspective, asset shows obviously what a company owns. From a liability perspective, that shows what a company owes. And then your net assets are the difference between your assets and your liabilities. And basically, it's also labeled retained earnings, and it's the value of the earnings that can be reinvested back into the company, especially specific to not-for-profits. Everybody has the understanding that as a not-for-profit, you're not supposed to make money. But that's not really what the ultimate goal is. The ultimate goal is to be able to provide the services to everybody, whether they can pay for it or not. However, in order to be a viable system, you still do need to make money. However, that money, though, needs to be reinvested back into the facility. Our statement of operations is just your revenue and expenses, and then your net profit. Your statement of cash flows gives a summary of the cash receipts and payments for a given period. And then your statement of changes in net assets is specific to anything that changes what we recognize, just specific to the balance sheet. So it's your unrestricted, and then it's your temporary restricted and your permanent. We'll go into that in a little more detail. So financial statements. So from a balance sheet perspective, this is kind of what the asset side of a balance sheet looks like. You have your current assets, and what's made up of is your current, is basically anything that's liquidated within a year. So you have your cash, you have any restricted cash, which might be specific to if it's a donation that was provided for a purpose, then that would go in the restricted category because it's not for anybody to spend. It's only for a specific piece of equipment or whatnot. Your investments, those are, we have short-term and then long-term investments. Your long-term investments usually are only related to any endowments that you might have. Most of the time, investments, while you know you're going to keep them for a long time, you actually have them in a liquid state, which means that if you needed it, turn it into cash, you could do that within a short period of time, which is less than a couple of days. Assets whose use is limited, required for current liabilities, so externally restricted. Really what that is if you have, say you take out bonds, and part of the bond requirement is for you to keep a reserve account. And in that reserve account, you have to pay in every month principal and interest payments, because at the end of the 6-month or the annual period, you're going to be required to pay, your interest and your principal. So they want to kind of make sure that you're making those payments, and they want to make sure that you can't pull it out. So once that money goes in there, it can only be used for a specific purpose. Then we have patient accounts receivable, less allowance for uncollectible accounts. So your patient accounts receivable basically is your dollars that are due from either your patients, your insurance company, Medicare, Medicaid, less there's always a reserve taken. There's a reserve taken for a couple of different reasons. Obviously, not everybody has the ability to pay, and then also everything is not contractually allowance down at the time of bill. There are certain contracts where, we might not have in our system, where it automatically sends it down, so you have to contract it down, you have to wait until the payment comes in, but you don't want to record it at a higher level than what you expect the payment to receive at, so you're going to allowance it down. So basically you have gross accounts receivable, and then you have your reserves for both uncollectible and contractual amounts. Your supplies and prepaid expenses are anything that you pay for up front but are amortized over an annual basis. So if you have a service contract where the company is requiring you to pay $100,000 on January 1 if you want me to service you for the year, you're not going to recognize $100,000 in January as an expense. You're going to amortize that over a period of time, however long the contract's for, and basically it'll sit in an asset until it's expensed. Other current assets are really just other receivables. If you have rental income and you book on an accrual basis, so you know that this person owes you rent, but you actually haven't received the cash. So you'll book that as a receivable, and when the cash comes in, then you would lower the receivable. From a current perspective is you would expect it to come in within the year. So then we move on to long-term assets. Long-term assets, again, the same, externally restricted or usually related to bond funds. Long-term investments are any type of investments that are usually earmarked against endowment funds. And then property, plant, and equipment, and you always record this at net. So you have what you purchased, let's just talk about Vassar Hospital. So you have what we purchased Vassar Hospital at a point in time, which it gets amortized over a 40-year period. So you're not going to record on your balance sheet, what the asset is at the time, even if it's 40 years later, what it's worth. You're going to record the book value. And that's basically the gross less the depreciation on the asset. Your goodwill is also recorded at net. Now, they used to allow you to amortize it over a 5-10-year period. The FASB changed rulings a couple of years ago, and they now require you to do an intangible review to value the goodwill. So basically, every year you have to look and say, okay, well, I purchased this physician practice at $500,000 in 2015. And come along 2016, is that practice still valued at $500,000 if I were to buy it today? If it's not, if it's valued at $600,000, that's fine. You can still leave it at 5. If it's valued at 4, then you have to lower your goodwill and you have to recognize an expense for $100,000. And then other assets from a long-term perspective would be any type of, deferred comp, any type of physician loans that might be over a longer period of time would roll up into that. And then we have liabilities. So liabilities are broken again also into current and long-term. Current is payable within a year, long-term is payable after that. You have your current portion of long-term debt, which is basically your principal payments for the year that they're due. Accounts payable and accrued expenses is for anything that it has been recognized an expense but has not been paid yet. As overseeing the accounts payable department for close to 10 years, everybody knows that the invoice comes in, but we don't always pay it on the day that it comes in. We pay it and try and stretch our cash a little bit. Whether you agree with that or not, it is a accounting functionality. And then amounts due to third parties. So those are amounts that we know based on an audit or based on just different cost reporting and financial regulations that at the end of the year there's going to be a calculation where we might have to owe money back. So that's where that is recorded. Then you have your long-term debt, which is net of your current portion, and that's basically everything that you owe to others. And then amounts due to third party and also other liabilities. The long-term portion of amounts due to third parties would be what we label just a general reserve. So at some point in time, while we like to think that we do everything correctly, that there might be something that will come up in an audit where we did not bill correctly, so we have to pay it back. Well, some of that is unknown, so you do keep on your books from a hospital, even a physician perspective, if you're doing accrual accounting, a reserve. I mean, it cannot be a very large reserve. You can't hide money in there and say, this is where it has to be less than a certain percentage of your total revenue. Based on how big the company is obviously your greater risk. But that is audited and it is monitored. And you have to earmark what you believe it might be used for. Then you have your unrestricted net assets, and that's basically the value of the company and what you're able to reinvest. Then you have your temporary restricted assets, and what that is utilized for is if you have money from the foundation and they donate, $100, the $100 will sit in a liability and it's temporary restricted until it's spent. When it's spent, then it gets released, and then it moves to the P&L. Your permanent restricted is really just endowment funds, and that is kind of going to the wayside these days, unless you're a large, education institution. You really don't have a very large. So balance sheet. What should you focus on when looking at the balance sheet? So current assets basically represent what's available within a year, and then your current liabilities represent what you have to pay within a year. So one of the ratios that you can look at to basically state whether or not this company is a good company to look at or work for is what's the ability for the company to meet its responsibilities. So a ratio of less than 2 to 1, so meaning that your liabilities outweigh, your assets to your liabilities are a 2 to 1 ratio, can be a sign of a financial stress. So the closer, if your liabilities are $100,000 and your assets are only $100,000 or they're actually less than $100,000, then you know that that company's in trouble. From a PP&E perspective, why we always look at a net value is you can then actually be able to value what the age of the plant is. Long-term debt, which is loans, generally associated with the purchase of buildings. What rating agencies seem to focus on a lot these days is a cash-to-debt ratio, and basically it says, what is your total debt and what is your total unrestricted cash? And a ratio of 1 is considered a good indicator of the company's financial stability. The higher you get, the better it is. So does anybody have any questions on balance sheets, or do you want me, if you don't, I'll move on. Statement of operations, or profit and loss, which we refer to as a P&L. Basically, you have your net service patient revenue, and then you have provisions for bad debt. Again, a couple of years ago, FASB came out and said bad debt is no longer considered an expense. You're not going to show it below in the operating expense line. We actually want you to show it above where you show net patient service revenue, because that really gives you the true cost of, or the true revenue that you received for the services that you provided. Other revenue is, it's cafeteria, it's rental income, it's affiliate revenue. Then from an operating expense perspective, you have salaries, you have employee benefits, supplies, other expenses, interest and depreciation. And these really are like the main groups that most companies will report on. They don't get into too much detail because while you like to be transparent, you don't like to, nobody's going to read a 15-page financial statement. They want the summaries and they want to know, the good and the bad. Usually it's always comparable against a prior year. And if it's a month, it's always comparable against the month from the prior year, and it's also comparable to budget. If it's year-to-date, it's comparable to the year-to-date for the same month. On the balance sheet side, though, you always, because it's always a year-to-date number, you actually always compare it to your year-end from the prior year. Then we have operating income, and basically what that is that tells you what your total revenue and expenses and the money that you either made or lost related to the operations of the company. So it doesn't have any type of one-off, which has nothing to do with, why you're in the business today. So your investment income, your gain or loss on the sale of property, your grant revenue, and then net assets released would all be recognized, what we label below the line, because it doesn't have anything to do with operations, so it shouldn't tell you what you're actually doing as a hospital and how well you're doing. But it does build into your unrestricted net assets retained earnings. So there's two types of accounting. There's accrual accounting and there's cash basis accounting. So modified cash accounting is basically the transactions are received at the time cash is exchanged. So either at the time the patient pays or at the time that I actually pay the invoice is when everything is recognized. Accrual accounting, which is GAAP regulated, are transactions that are recorded at the time that they're incurred. So if I see a patient on, Wednesday, I'm going to record that revenue on Wednesday, as opposed to 2 months from now when I receive the cash from the insurance company. And the reason that's really done is basically called the matching principle, because you want to be able to, in order to get a true understanding of how well you're doing, you want to be able to match who you saw today with the expenses that you recognize today. And then you can kind of have a better picture of how well you're doing in your specific area. So, accrual accounting. So what are the advantages of accrual accounting? Basically, there are rigorous standards of the application of principles of GAAP. You have to follow, you get audited, and there's corporate entities subject to audit, and also it meets the requirements of any lenders or tax filings or investors. As you go out for, especially tax-exempt money, you have to, one, have an audit, and then your tax filings all have to be done on an accrual basis, because, again, that gives them the true picture of how you operate. Part of the disadvantages is it's complicated. It's not as simple as cash in, cash out. It does not always match the business because there are some fixed costs that do have to get allocated, and there's always a conversation about how those get allocated back down to, specific departments. So modified cash accounting, what are the advantages of that? It's simple to understand. It's like your checkbook. You know what your balance is every day. The money comes in, the money goes out. It's really, though, it focuses on short-term performance, not long-term. And then the recognition of expenses and revenue, it does not involve the calculations of, reserves or allocation of expenses. Some of the disadvantages, though, it doesn't recognize all the liabilities that you actually owe. It does not recognize revenue as they're earned, and then it doesn't recognize expenses as they are used. So uses of accounting methods, so health systems, hospitals, physician organizations all use accrual accounting for reporting purposes. There are some physician offices that do use a modified cash accounting, and a lot of that is really for internal reporting. At the end of the day, the larger the physician group, you really have to move more towards the accrual accounting. There's probably very little companies or even physicians today that use a cash accounting system. And then in regards to hospitals, when they do their departmental reporting, because from a contractual allowance perspective, those are taken by payer, the department gross charges are booked by department. So there is a little bit of a disconnect to be able to actually bring down the revenue to a net perspective on a department level. So there is a series of, calculations. We have a separate system that does it. But to do a quick snapshot to really see what your volume is versus your charges is, most of the time, the departments will get a report that'll show you gross, because that kind of gives you, it doesn't tell you what, from a net perspective, that involves whether it's, Medicare or Medicaid and Blue Cross, and, it gives you, it kind of skews it, because if I'm going to get paid more from Blue Cross, then it looks like I did a better job, but yet, if I have a more Medicare population, then it's actually going to be lower. So you really shouldn't be penalized on that. So a lot of the time, when you go to, I know Ann has them, the monthly operating reviews, it's shown at gross. And it's shown at gross because it gives you the perspective of what's my volume and how much actual charges did I receive. And then we do have a cost accounting system at the corporate level, which then will give us, a true net perspective. These are the costs that are assigned specifically to this service line. These are the payments that we received on that service line based on the payers that we have, and then we allocate indirect costs. So that kind of helps us make decisions as to, how to move forward with, certain service lines. Is it based on historic? Do we grow? Is this something that we need to look at? Is this, beneficial that while it might not make money, but what other impacts does it have to the hospital? So that is one of the systems that we use. But again, it's not just a simple, profit and loss statement. There is a basic separate system that actually allocates all the costs and revenue to certain service lines based on volume. So revenue recognition. So for patient service revenue, we have gross service charge. And that's the amount of charges that results from the provision for the services that are provided. And that's basically what you would call your sticker price. Net patient service revenue is the amount that remains after reducing charges for contractual rates based on what your contract is with the insurance companies or what Medicare says they're going to pay you for this specific DRG. And then you also estimate what your charity care is going to be and your bad debts and any denials. So changes to gross patient service revenue. These are just a little more of the details. So contractual allowances and denials. Contractual allowances is the difference between the rates billed to third party and what will actually be paid. Denial reserve is for contested amounts adjusted by payers based on clinical denial, bundling of services, and other contract interpretation issues. So everybody knows that, we send out our bill, which supports our medical record and our coding as far as what we believe, we've earned based on this patient and what services we provided. The medical or insurance companies, though, sometimes come back and say it was not medically necessary, you didn't get prior authorization, so there's a whole different various reasons where they could easily come back. Some of it's more of a tactic to delay payment. Others is it's a learning tool for us. to say, okay, well, this is, what they specifically want to see. Let's make sure that we do that in the future. And, that's mostly with, like, the prior authorization. Then we have charity care and bad debt. Charity care is provided to the patients who meet state and or federal criteria at no charge or at reduced rates. So HealthQuest does have a charity care policy, and basically at the time of the self-pay, a patient is automatically reduced to the Medicare rate. And then after that, we do have a financial clearance center and a outside third party group that works with anybody who is labeled a self-pay patient to validate and make sure that they either don't qualify for charity care, or if they do qualify for charity care, let's get them to fill out the application, and let's get them to go through the whole process. Because from our perspective, it's actually better if we can get them on a Medicaid charity care program than it is for us to leave them as self-pay and then write them off as bad debt. And then as we move forward, we do have risk contracts. As everybody's working towards, pay for performance and quality, there are contracts that are getting, built in with quality indicators. I will say that, this area is not quite, 100% into that. We only have about 10% of our contracts right now that has a risk-based built in, but that's definitely where, the country is moving to. The rates that we get paid today are not bad, so we will continue with that. Anytime they want to pay us for quality, we're going to ask for that over and above, not instead of. So from a hospital perspective, you have a patient type. We have inpatient, outpatient, and then we have observation. So Medicare came about 5-6 years ago and decided, you know what, if a patient is in the hospital less than 48 hours, that's not really an inpatient. I don't want to have to pay inpatient room and board and all of it. So we're going to classify the tube midnight rule. The patient's less than 48 hours, we're going to pay you with an observation rate, and which is about 40% less than what we would have paid you on the inpatient side. Yeah, we understand that you're still providing the same services, the same nursing staff, and the same quality of care, but this is how we're paying you moving forward. There was a lot of discussion going back and forth. There was a lot of lobbyists in trying to justify. However, we did get so far. They still have the two-midnight rule, but we are able to now fight it with the physician interpretation of whether or not they really are classified as an inpatient. So our payers, we have basically a couple of different groups, managed care organizations. You have your Aetna, your Cigna, Blue Cross Blue Shield, and these are organizations that offer managed care health plans such as HMOs. They also manage the allocation of health care benefits. Yeah, sorry.
Sorry to interrupt you.
Yeah, no.
Going back to the observation.
Yep.
How much less do we get paid for a person on observation as opposed to an inpatient? Or is it my impression that it's a whole different way of collecting from them?
No, actually, we get a lower reimbursement, and it's about 40% lower. So it is a significant difference. And it's just, we experienced a very large, what I would say, transition of, between inpatient and observation patients a couple years ago. And now, actually, we're not seeing so much. We are able to justify the patient stay. I think there's, in a way, it did help because there is more focus on, if the patient is in-house for only 48 hours and it's like a watch. They are, most hospitals are in the process of setting up what's labeled observation units. So this way you can separate and categorize and kind of manage their care a little bit differently than kind of intermingling them with an inpatient floor. But you do get percentage.
So you could lower the expense.
Exactly.
Okay, good.
Yeah.
Are you finding, are you getting anybody balking on paying for an observation stay? Because what we're starting to see in the outpatient side is they don't want to pay for the observation stay.
No, we have not gotten that point. You know, all we've gotten is basically what we call innies to outies. Is that the inpatient was denied and that they're reclassifying it as an outpatient. It's not that they're reclassifying it and not paying it at all, they're just reclassifying it to an outpatient. So we still are getting paid, it's just that it's significant.
Right.
For post-op patients, what's the difference between the observation and this 23-hour post-op category?
So it depends on actually how the diagnosis is recognized by Medicare right now. So there are some diagnoses that are considered inpatient even though the patient is in the hospital less than 23 hours. So they will still accept an inpatient coding, they will still pay at the inpatient rate. But if there are codes, though, that are specific to outpatient. HMOs are just healthcare management organizations. It's a form of a health insurance in which members prepay and that the HMO manages their services. CMS is the Center for Medicare and Medicaid Services, and basically that's the federal agency. Medicare is an entitlement to, you know, everybody who's 65 years or older. And it is broken out into a couple of different categories. Medicare Part A covers inpatient, Medicare Part B covers outpatient, and Medicare Part D covers pharmacy, and it's a voluntary plan. Medicaid is an entitlement program run both by the state and CMS, and it's for patients that are younger than the age of 65 who can't afford private health insurance.
Is that entitlement, I'm sorry, is that entitlement a misnomer, though? Because don't people pay into Medicare?
So in Medicare Part A is considered a covered service, but Medicare Part B and Medicare Part D are what's considered voluntary. So yes, you would pay into that. So yeah, it's not a freebie, so to speak, but inpatient services is considered part of the free service, or a covered service, I should say.
But it's entitlement that it's mandatory spending on the part of the federal government. Discretionary spending, like for defense, but there's mandatory spending, which is you have to spend this money collected from tax revenue on these programs. So now we're entitled to, even though we paid in tax dollars. It's mandated that this will be spent for that.
All right, so payment methodology. So we get paid a couple different ways. I'm actually going to just jump to the bottom and then go back up. So charge master, and basically what the charge master is a master file that contains all gross charges by CPT code. And your CPT code is a medical code that's used to set the medical, surgical, and diagnostic procedure for entities. So there are various different ways that we do get paid. Case mix plays a role, and case mix is basically, it kind of tells you how sick the patient is when they came in. It tells you, you know, their risk of mortality. It tells you whether it's, you know, if it's a newborn, there's obviously a lower case mix than doing a TAVR procedure, which is a very high case mix because it's the level of complexity that's associated with that patient. What we call a DRG is a diagnostic-related group, and this is to classify patients, especially Medicare, for the purpose of reimbursing hospitals. So basically, when I say Medicare will reimburse us per DRG, they have certain categories, you know, that they've combined, and they'll say for, you know, this specific DRG, this is what we're going to pay you. Then there is an all-patient refined APR DRG, and that's a classification system that classifies all patients according to their reason of admission, their severity of their illness and risk of mortality. And then outpatient is ambulatory payment classifications, which are APCs, and then from a New York State outpatient, it's an APG. So how do we basically get paid for inpatient and outpatient care for each one of these payers? So for Medicare, we get paid based on a prospective payment system based on the DRG. From an outpatient, we get paid based on a prospective payment system based on the APC. Medicaid is based on APR DRGs, and outpatient is based on APGs. Managed care and commercial are contracted rates in the form of either a per diem. So a per diem is basically what you would get paid to have a patient per day in your facility. A lot of the contracts today obviously don't pay on a per diem basis because the longer you have the patient in the hospital, from their perspective, they have to pay you more, when in reality, you know, the chances of that patient getting sicker is higher. So the only ones that we're really seeing on a per diem basis is our mental health. Those we still do get paid on a per day. Nowadays, everything's really more of a case rate or a per case. So for a specific diagnosis, this is what we will pay you. Whether the person is in, you know, 5 days or 2 days, it doesn't matter.
What do they decide, CMS decide, goes into a DRG? So in other words, a person comes in with a diagnosis. Does that include the fees that will be, in this case, say a stroke, like the fees for an MRI scan, since that's what we do for a stroke patient? Do they take that into consideration at all? How do they come up with the number?
Yeah, so that would be taken into consideration. So basically, any inpatient procedures that's done, it's not just specific to what I would call bedside care. It's also related to any of the ancillary. It's all built into that. And then from a managed care commercial, from an outpatient perspective, it's basically the same. It's contracted rates per visit.
So for outpatients, whether it could be based on the code, whether I keep them overnight or send them home the same day, you're going to get paid the same?
From an outpatient? Yeah, because it's based on what you're doing today. It doesn't, if that patient is there 12 hours for a specific procedure,
or they go home right after, it's still outpatient.
It's still outpatient, so it's based on, and hopefully based on the coding, you would kind of add to it. So if it's just a basic, you know, they come in for a infusion, you know, then if they're here for an infusion plus complications, then that piece would add to it and you would get reimbursed more. But if it's just a flat, whether they're here for 2 hours or 4 hours, it is the same, if it's the same type of procedure.
And it can be confusing in this sense, because it's not just time-based. I don't know if you'll go into this, Catherine, or not. CMS has also designated a number of procedures as inpatient only. And a number of those inpatient only, I remember carotid endarterectomy is an inpatient only procedure, yet we have many vascular surgeons who turn that around in 23 hours.
Right.
And think that's 23 hours, they have to do the right thing and get the patient out and bill it only as 23 hours.
Right.
But it's inpatient only, and we end up, so it's there's a lot of complexity to it.
Yeah, so that's kind of what you have to look at too, is that if it is a Medicare inpatient only, you actually cannot bill it as an outpatient, even though they were only here less than 23 hours. You actually have to bill it as an inpatient. So, I mean, it's part of it is Medicare hasn't quite caught up with, you know, some of the things we are doing quicker. And I mean, orthopedics is one of the largest things that we're looking at right now, is because for, you know, knee replacements and, you know, hip replacements, people are actually leaving the same day and they want to go home. And yet that is considered an inpatient procedure, and they're supposed to be here overnight. But technology today doesn't, you know, dictate them to be here for that long. So it is kind of a catch-up, so to speak.
And you, the physician, think you're doing the right thing by saying it's 23 hours, I got to make sure it's in the right status.
Right.
Then you get called from finance saying, no, you're wrong.
Right.
The hospital saves money. If you
Yeah.
do an inpatient only procedure, the patient goes home the day, you're getting paid by the DRG. You're still getting money rather than to have
Some portion of it. Right. Correct.
So the longer they're staying here, like if they have complications, they stay here for 10 days, you're still getting paid for the same. So in a way, it's still better than something.
Yes, but then we also have the readmission penalty.
Right.
So they cannot come back within 30 days, or you basically get to. So it's definitely a fine, you know, because I think that's part of why they ended up putting that in, is because everybody started focusing on length of stay and getting people out, and then less than 30 days later, they were back in, and they were like, hold on a second, you know, let's take a look at this and say,
Right, and I think the converse, that's also very important too, because we get the case rate, so a case rate with less urine lane, the case rate paid for pneumonia. So if we're going to pay to treat pneumonia, Medicare doesn't care how many colonoscopies we get on that patient who's being treated for pneumonia. It doesn't impact what we then get reimbursed. So they're less concerned about holding us accountable for utilization and put that on us. For the appropriateness of services that we provide to a patient who's inpatient for a particular DRG, and we stray outside of that for other services or care. All right.
So our other types of revenue that I talked about was cafeteria, rental, grant income, research, and then stipend revenue. So expenses. Basically, a couple different categories. It's broken into salary. So salary consists of the amount paid directly, hourly, or exempt, and what we would classify as W-2 earnings. It may be paid weekly, biweekly, bi-monthly, monthly. It includes all pay that's associated with overtime, shift differentials, certifications, special pay, and it also includes any temporary or agency staff. Bonus and incentive payments are included in salary, and most of the bonuses or incentives are categorized as either productivity or quality-based, which are common for physicians. The other expenses that roll up into the salary line are what we label for future pay for employees, such as earned sick or vacation time, and what we call here a health cost or PTO role. Basically, as you work here, you earn hours to be able to be paid at a later date. If you leave the organization, whatever is in that bank gets paid to you up to the policy limit. So if you have, 300 hours in your paid time off bank and you do leave the organization, that is money that's due back to you because we have a cap of 320 hours per year because you earned that and we're just unable to take it. Benefits. So benefits are broken into three categories. You have health and welfare, which includes your dental, your health insurance, your life insurance, disability insurance, and any types of employer paid.
With expenses, you mentioned like the workers, so you take Bassett Brothers. The workers in the cafeteria, now is that a separate group from HealthQuest or is that part of HealthQuest?
So they're Vassar employees, so they are part of the system. They're not contracted out.
Oh.
The management of the cafeteria is contracted out for Vassar. Aramark is the company that we pay to manage the cafeteria, but that's really the only service that's contracted out from that perspective. From the benefits, retirement benefits, which includes pension and other savings programs, and then also is employer portion of taxes, which is the employer portion of Social Security, Medicare, workers' compensation, and unemployment. Benefits can range anywhere from 25% to almost greater than 40%, and there's a direct payroll, and the calculation depends a little bit on, from a physician standpoint, because their salary range is a little bit higher, their percent of benefits to their direct payroll might only be 18%. But when you look at a union organization and what we pay into union benefits, that right now is close to 45%. So it is a very hefty expense. Non-salary are basically broken into a couple different categories. You have your supply expenses, which is medical and surgical, pharmaceuticals, implants, anything that's labeled, patient chargeable. Utilities are your electricity, your gas, your oil, and your telephones. Other expenses are, basically the services that you purchase from outside vendors to kind of maintain the hospitals. So it's your, if you're renting service contracts, it's legal, it's consulting, it's travel. Corporate allocation is the cost related to centralizing services. So at HealthQuest, we do have a centralized management of finance, of human resources, legal, information technologies. So the expenses that are incurred at what we call the corporate level do get allocated down to the hospitals. And there are various different ways the allocation works. You know, if it's for a specific area, like HQ&P billing is actually a HealthQuest department, that gets allocated back to HQ&P directly. You know, finance, because I do the financials for everybody, that gets allocated as based on a percentage of net revenue back to the various facilities. So it depends on how you look at it. The better you do, the more allocation you get, but it's a fair allocation. Depreciation and amortization, basically these are the expenses associated with the diminishing value of the asset. So again, if you buy a piece of equipment, the average life of medical equipment from a bookkeeping perspective is 8 years. So each year you would take a portion of that piece of equipment as an expense. So by the time you end up at the end of 8 years, you have no value of that equipment on the books because there probably isn't much value to it if you were to sell it. And then your interest is basically your cost of debt. So how much your interest expense is on whatever debt you have, that also is recognized. Okay, that's it. There's your financial statements.
You talked about overhead. I think that's one of the costs that we don't have much influence on. But I think, costs or expenses, and we're a nonprofit organization, so anything that HealthQuest or Vassar, develops as net operating income goes back into Vassar, goes back into the community, big bed tower. I mean, that's what that is. And I think there's two things we have to keep in mind around that. Where we have the most impact on income is, okay, providing great care and documenting it. That's it. If we provide great care and document the severity of illness, the DRG changes, the severity, the CMI goes up, your documentation, so you have a tremendous impact on what income is there. And then the other side of it on the expense, and this is where it kind of goes into quality, is our largest point of influence is what are called direct variable costs. And for direct variable, on the one hand, we look at Brian or Dan and say cost of supplies, or cost of the pieces of things we use, and then a lot of efforts in orthopedics to standardize around particular hip joints or whatever it might be. So that's a direct variable cost. And then if we look, say, in Tom's lane on the primary care side, direct variable cost, and same with Dan in surgery, that is around variations in care. And you see tremendous variation in care. And when there's variation in care, no longer about quality, and that has a cost, to it, both in terms of how we give the care, resources allocated for a 10-day length of stay versus 4-day length of stay, or resource allocated for 12 visits a year for diabetes versus 4, in an outpatient setting. And those are things that, when we talk about, pathways and for standardization of care, it's really getting at not just the cost from a dollar standpoint. It will come down, but as we move towards decreased variation in care, we also see improvement in quality. As we move more towards what guidelines say and outcomes are. And so it has a twofold increase there as well. But when we look at the expenses, that's a tremendous impact for us on the direct variable costs. Positions that a large impact. Can't impact what we're paying for the diet management of the cafeteria. We can't impact.
So, Mike, where does the whole issue with the MRI scanning come up? I mean, the whole concept of, because if the DRG contains the concept that you're giving some money for the MRI scan because the patient has a stroke, okay, then is it the idea that if you get the CAT scan on the second day as opposed to the MRI scan, you're saving money because the CAT scan is cheaper, and if you're making money that way?
No, I think it's if you ordered 5 MRIs. Like, or I'm just, now remember, I'm a finance person, so
But also,
nobody would do that.
It's the statistical likelihood that you will get an MRI. So for stroke patients, 1 out of however many get an MRI, that's what's cooked into the rate, not for that individual patient. It's cooked into the big thing. So, for every 5 patients that you get stroke reimbursement for, maybe you'll have 2 that have reimbursement in there for an MRI and 3 that don't, because it's all based on statistical probability. Plus, they're never going to pay you what it costs. So.
But also, though, I mean, how does that allow for then advancement of science or advancement of how to treat a patient? Obviously, the move is to do MRI scans for stroke patients because the CAT scan often won't show a stroke, but an MRI will. But then if you're relying on an old way of charging and billing, how do you get ahead when science itself or technology changes and is using the old antiquated system?
It is old and antiquated, and it's always going to be.
Yeah, and I think
but some of that also helps because sometimes you get paid for, what used to be a 5-day length of stay is now a 1-day length. So it's kind of balancing.
I think the other side of it, how does so on the one hand with the new technology, we're keeping up with, how are we part of the study looking at that? Okay, that's one way to offset the cost. But more, anything with the MRI just in clinical practice, and how does it change the management? Will the MRI reveal something that will change the management acutely of this patient? And whether it's an MRI, whether it's a colonoscopy for a patient here with presumably pneumonia, it's an admission DRG, and there could very well be a reason why we're getting a colonoscopy. We understand we may not be baked into the rate, but if that colonoscopy is going to change how we manage that patient acutely, and by acutely I mean the management right here, right now in response to those colonoscopy findings, we're doing something different because if we don't, the patient will have an untoward outcome right here, right now. Then it's less of a concern. But what are we doing right here, right now? And I don't know, and the data may still be out there on the MRI. You would know better than I. My experience with that has been that it often more feels like the aha moment that you did have a stroke.
Right.
But we already
sometimes it feels like you're documenting what you already know.
Sometimes a patient comes in, you're not quite sure, and you say, I'm not going to do the cerebral vascular workup until I see the MRI scan. Otherwise, I'm not going to do the echocardiogram or the CT angiogram or the cardiac ultrasound because right now it's suspicious for a stroke. Unless I can do the MRI scan, no, I'm not going to go ahead and start doing all this other work.
Right.
Agreed.
And then you have to ask, but we need the patient to be in the hospital to do that versus when it be done as an outpatient. And I don't know. And it varies from patient to patient. So that's the next observation or.
correct. And your first decision should always be for the patient. We do obviously want you to think about, the cost associated, but again, your first inclination should be what is best for the patient. I don't want to stand up here and tell you guys to don't do MRIs because no, that's not that.
No, and I don't think for me on the MRI, it's a cost issue. It's, more go back to utilization, beds. It's
the length of stay you're waiting for, right? So.
Anybody have any other questions? There are some procedures that we do that aren't even, there's not even a CPT code for them. We get back to it. Things don't keep up with what is current medicine. Laparoscopic liver resection, there's no code for that.
No, and then you end up picking what you think is the closest. And
you can't just pick. If I do a laparoscopic right hepatectomy, the patient has smaller incision. The morbidity of a liver resection is the incision. Once it's out, then off. And then if they stay in the hospital for 5 days, they used to have the old shut-down incision. So then they go home 3 days or 2 days. But when we try to build, you can't just build right hepatectomy and say, well, I did a laparoscopic. You don't pay that. So you have to build unlisted laparoscopic procedure, and then you have to write a letter. So I did a right hepatectomy, which is the same as a right hepatectomy. Instead of these small incisions, these pass the amount that we pass for right hepatectomy. That's on the
from the professional
professional fee side, I don't know what the hospital does. Do they get the, right, to have protection of the CPT code and try to get the same DRG for that?
Yeah, I'd have to look at that specific example.
If it goes under unlisted laparoscopic procedure, that's like anything, oftentimes they just deny it. So that's a lot of these new things that are coming through. You gotta write a letter, then you have to wait for the refusal to pay, and then write another letter, and
Send them the out.
send them the outcome.
Yeah.
Yeah. So on the, yeah, unless you follow up on it, really, yeah. So when it goes off to like the billing department, it has to come back to the coder and then back to me. Sometimes it gets lost.
Yeah, and then 90 days out.
Right. So then on the hospital side, I'd be interested to see how they do it. Same DRG.
Yeah, I'd have to look at that detail, because I know there has been, some questions as far as, what I report that we're doing, and, trying to understand exactly, based on the CPT code, what actually is the built-in different various components of it.
So I've had some conversations with the hospital side, that their CPT code usage is very different. Now on the hospital side with the ICD-10,
Yeah, there's
all the organs that you took out. Sure.
Yeah, so I was going to ask, because ICD-10 is, increased by tenfold the amount of diagnoses you have, is CPT going to undergo revision soon, or I don't know.
Yes.
They just choose for us on the outpatient side. If you're trying to provide full service, which is what the demand is, from a patient-centered medical home and these other initiatives, comprehensive care plan, they just say, they were for this, you were going to help the patient out, we're not going to pay you for that. They just don't. Payers just don't pay you for doing stuff. But CPT, if they have stuff like that, that has to be revamped just like ICD-10.
It has to catch up. It's probably 5 years plus behind.
Yeah, technology is definitely moving faster than.
There's no problem.
No, I read something about it a couple of years ago. It reminded me of a conflict with cardinals. It occurs frequently. And it's AMA folks who get together, okay, they sit in a room and they decide what all the stuff is worth. And the complaint about it, there was a discussion about it, criticism of it was coming from the cognitive specialties, like neurology and stuff, to say they're underrepresented in favor of the procedural specialties, and there's a clear weighting of the discussion going about, but there wasn't, I don't recall from that article, the discussion of the frequency or regularity of it, that the AMA is what actually then inputs and goes out to those coding organizations, that this is what we believe you should be giving weight to, and what the value of these things are, and this is what we're doing. And, okay.
It's very interesting with the documentation standpoint. You can spend 5 hours on a person and go through that person meticulously and document meticulously. Spend another 2-3 hours writing a note that I think, this is great. Then my coder comes back and says, well, you didn't document that you twisted this toe this way, so you are dropped down from a level 5 to automatically a level 1, and you say, wow, my value is based on how I've documented this. And what I'm seeing is this. I thought I was doing a 5, and I gave my effort and my time as a 5. But now at the end of the day, all of that work is a 1, and that's the only thing that's going to be remembered. So it's actually very interesting to see that, how they play these games. And then you start saying, well, I have to play the game back and adjust my note to fit their criteria, where you're doing everything, but it's being underrepresented.
We do time.
Okay, for that reason. Okay.
Because I can't do
Right.
And so most of our talking.
Okay.
So we go, it takes time.
Got it.
We have to do that because if we just,
Yeah. You have to drop down and get beat up.
Payers don't like to pay for the emotion, the psychological part of care.
Well, the cancer
They don't,
Because you can't
spend a lot of time doing that, and you can put it down.
You can't judge value with that. You can judge it if you take an appendix out that's all infected, but how much value do you have?
But the value is in the patient's head, and they're the ones that should be writing the note, that we.
Well, absolutely. We can't just walk out when we're talking about
Right.
cancer.
Yeah, so, what I got out of this visit, the doc got nothing, but I got a lot.
Right.
But, we're stuck with that.
In regards to the DRG,
No, like,
is that diagnosis rated on the discharge diagnosis?
Yes, well, it's based on the discharge diagnosis, but it encompasses everything that happens to the
And it's
patient.
good to accumulate a lot of diagnoses, like hypertensive, hyperlipidemia, some more things you accumulate, the more.
More validated complexity you can show, yes. I mean, it has to be based in fact in the record. Not just simply that it's there as a code that's put on the end of the note saying hypertension. It has to be established by the record.
So then what happens to us when we bill? Like, say I saw a person coming in, and I thought it was a TOS paralysis, or I thought it was a seizure, but in reality it was a stroke, and it works out doing the workup. Now, my billing went in on the first day. I put a bill in with a diagnosis of seizure, but then
The bill isn't actually dropped until the discharge.
Outpatient, all of our notes right now are generated.
PCW.
And then they get scanned into the center and they show up in the discharge. Do those diagnoses that we noted in our outpatient pre-op, they have 5 diagnoses of medical issues. Do those just transfer over to the hospital? Does somebody look through it? Do they have to get documented in the hospital?
They do, because it then actually supports the hospital visit.
So someone's going to go through the outpatient H&P and pick out those diagnoses.
Well, it's done electronically. I don't know in regards to whether or not the specific diagnosis, hopefully, like if the hospitalist then comes in and looks at that patient, they'll go back because they all have a singular medical record number, so then that patient would get, and when the hospitalist looks at them, they can look then at your records and be able to, do their diagnosis, and it gets added to.
The hospital stuff, I don't go through and pick stuff out of my pre-op and stick it on the hospital. I don't.
No, but it should automatically, so when they come over to Cerner, there is one same identifier. So basically, you could take that patient from the time that before they were admitted all the way until the time they were discharged, and that medical record is combined.
For that diagnosis, I mean, it's a scanned document. Somebody puts out a document and scans the chart. So if somebody reading that document and picking those diagnosis codes out and typing them into Cerner and putting them in
For the hospital side?
the hospital to increase the case.
No, because it's just supportive, so whoever is the physician that saw them within the hospital, that piece is what drives the coding.
So I can document my head off in the office, and then when the patient gets admitted,
you
they
have
have
to
their.
put them in yourself.
But you have a physician component of your bill that gets billed for seeing the patient in the hospital. So that piece is what supports the physician bill for the hospital visit.
Well, yeah,
For the surgery.
but for as far as the hospital getting the patients.
Right, they may not, if it's not in the inpatient record documented in those, it's just an outpatient record, it's probably not going to get.
So somebody, some physician or physician assistant or PI, look at the outpatient note and translate that to an inpatient. So that some coder on the inpatient side sees it. It's not going to get seen from a scanned in HCP.
Yeah, I mean, we can ask our clinical documentation specialist to take a look at that. So the clinical documentation specialist, both on the inpatient, patients in the house, and the coders on the outside, do send queries to you, put it in that, so I don't know if they're looking at those scanned-in outpatient records or not.
Well, I think this, your average 70-year-old has hypertension, has diabetes, I'm not going to document all that in my post-op. Discharge somebody with discharge.
And it's for all your comorbidities. I mean, the easiest thing in ECW is have someone get a hold of the medical summary. Because on the medical summary, it's all going to be there with the code. And all you have to do is plug codes. Somebody, but this is, again, who's going to do it?
Right. So every patient we operate on, you have to go and be event. If they're not going to, I'm sure the hospitals don't want to do this, but somebody's got to go find all their comorbidities and put them in as med. Otherwise, all of your operative cases are going to look very, very healthy. And your case mix is going to look bad, and you're expected to actual outcomes are bad because you're not documenting. Now, when we go over to outpatient Cerner, is that going to
That's
better? We're going to see that all of a sudden you're operating on 46 people all of a sudden, just through that documentation.
You need to consult.
Yeah, they do everything.
They do everything.
Surgeons are.
But as surgeons, we should stop and we put in what we did, and even if they
You shouldn't be doing that because there are people who are going to have so many comorbidities.
Right.
And like I said, it's the easiest place, and all you got to do is deal with numbers. Because if your ACW record is complete, it's right on the medical summary. It's one piece of paper you can get out of ACW. But you shouldn't be doing that. But you can't. Quite literally.
Well, if we could scan it in and put it in the chart.
Yeah, but it doesn't become part of it until somebody, enters it. So you need another data entry page. Yeah. The notes are there, but they're still not going to be integrated. It's just you can't do anything.
But if you have all those comorbidities, you have justification.
Right. Are you going to don't make the hospitalist type it all.
Well, no. I'm trying to
Well, it's
find
funny because
information.
that document that's your HEP.
Yeah,
Your
it is.
it's up, but it's a scanned in thing. It's not getting loaded
Right.
to our electronic record.
Yeah, it's just
Who
the
has what comorbidities.
paper file.
Yeah, well, that's unexpected. Okay. See what they're doing.
They should capture a lot
Yeah,
more.
they might be. They might
They're
be
referencing it,
it's
so
right, they might,
it's
it's in the record, and they might be, I think that, oh, it's because of what you do, you could.
It's Mayo Cleveland Clinic.
Everything else.
It's the same problem.
Yeah.
Nobody was capturing.
Right from the beginning.
So if I may,
Hospital record big, sometimes thousands of hours.
it doesn't matter.
North Carolina.
So,
That issue with the laparoscopic procedure.
because that's
We were doing laparoscopic,
without
the liver sections were like a computer.
Yeah.
So really for payers,
For payers, it's from an expense standpoint, because they are occupying.
yeah, we're not paying for a nurse.
Right.
They would try to do it.